Uber's first quarter 2026 earnings release presented an immediate contradiction. The headline numbers pointed to a consensus miss, yet the market reacted with a decisive 10% surge in the share price. On the surface, the results appeared soft. Revenue of $13.2 billion technically fell short of the $13.27 billion consensus, while GAAP earnings per share printed at just 13 cents. However, looking beneath those headlines reveals a different trajectory. Gross bookings rose 25% year-over-year to $53.7 billion, and adjusted EBITDA grew 33% to $2.5 billion. Institutional investors aggressively bought the stock because they identified two specific non-operational accounting adjustments that distorted the reported numbers. The Q1 print reveals how strict GAAP compliance often hides the actual economic velocity of a compounding technology platform. To reconcile GAAP reporting with actual performance, we extract the accounting noise, starting with as-reported revenue and EPS. The miss is explained by a $1 billion headwind from a UK business model reclassification. Moving UK driver payments from the cost of revenue line to contra revenue impacted reported growth by 9 percentage points. However, this accounting shift has no impact on actual unit profitability or cash flow. Next, we isolate the 13-cent earnings per share. Net income took a $1.5 billion hit during the quarter due to non-cash revaluations. This was not cash leaving the business. It was a required accounting adjustment for Uber's equity stakes in companies like Didi and Grab, reflecting changes in their respective share prices. Strip away the UK reclassification and the equity markdowns, and the results reveal a business that is clean, consistent, and compounding. Adjusted EBITDA margin expanded to 4.6%, supported by a record $9.8 billion in trailing 12-month free cash flow. Removing these non-operational artifacts exposes a business that is accelerating its cash generation at a global scale. That cash generation is driven by a deliberate operational pivot. Uber is shifting its focus away from simple user acquisition and toward increasing transaction density within its existing audience. The primary tool for this is OneSearch. Uber has collapsed the walls between its mobility, delivery, and retail services, allowing a single query to scan the entire ecosystem and output a unified results page. By integrating the user interface, cross-platform consumers are now growing 1.5 times faster than users who only interact with a single business line. This screen shows the mechanism driving that growth, a cross-platform quest offering a $20 credit reward. The checklist requires completing 2 restaurant orders and 1 ride. This is a trip-led strategy designed to bridge a user from an ecosystem they already know into a highly profitable adjacent vertical. We see the same architecture in the new Expedia partnership. In 2025, 1.5 billion mobility trips occurred outside a rider's home city, creating a natural entry point for integrated hotel bookings. Uber has engineered a product flywheel, where every incremental service lowers the overall customer acquisition cost for the entire platform. This density strategy centers on the subscription tier. Uber One has now reached 50 million members globally. This chart breaks down the $53.7 billion in total gross bookings. Exactly half of that volume is now generated by members paying a recurring subscription fee. Institutional investors track this metric because it shifts the valuation model. The high retention and visibility of these members transitions Uber from a transaction processor toward a predictable subscription platform. The platform continuously layers in new utility to cement that retention. Members now receive 10% back in Uber One credits on hotel bookings, which feeds directly back into transportation and delivery. In retail, they implemented a no fees above $60 benefit on grocery orders, a threshold engineered to capture the high-frequency weekly shopping cart. With half of all bookings coming from a locked-in audience, Uber's revenue visibility has reached an inflection point that the market is only beginning to price in. That predictability is pairing with a shift on the cost side. Uber is decoupling its research and development expenses from its revenue growth through artificial intelligence. Management disclosed that 95% of the company's engineers now use AI coding assistants on a monthly basis. This chart maps the productivity leap. AI agents are autonomously authoring more than 10% of Uber's production-ready code. Output is scaling while engineering headcount remains nearly flat. The output per dollar of R&D expense is rising, allowing the company to capture growth without the cost of aggressive hiring. They are simultaneously pushing these tools into the marketplace, launching a cart assistant for consumers building grocery lists and an earner assistant to help drivers navigate complex marketplace data. By reducing friction at checkout and preemptively solving driver issues, these tools directly lower the costs associated with customer support and marketplace matching. Uber is now demonstrating tangible P&L-level evidence of artificial intelligence driving structural operating leverage across its workforce. Combine the cohort density, the subscription mix shift, and the AI-driven cost controls, and it is possible to project Uber's forward earnings power. This graph extrapolates management's current 18 to 22% gross bookings growth. At this pace, annual gross bookings approach $270 billion by 2027. Note the margin line. The operational leverage points to an expansion from the current 4.6% toward a 7% target. Applying a 7% margin against $270 billion in volume implies an annual EBITDA potential of $16 to $19 billion. Now factor in capital allocation. Uber is executing a $12 billion annualized share buyback program against its $175 billion market valuation. By steadily reducing the float, this denominator reduction compounds earnings per share growth even if top-line growth remains constant. They are also scaling enterprise units, targeting 1 million organizations and $10 billion in high-margin Uber for Business bookings by 2028. The combination of 20% organic growth, margin expansion, and aggressive share buybacks creates a mathematical setup for massive per-share compounding. The final strategic layer is the autonomous vehicle transition. Uber is positioning itself as the demand layer for the impending hardware alert. Rather than absorbing the heavy capex required to build fleets, they are executing an asset-light partnership model with OEMs like Rivian, Wave, and NVIDIA. Hardware developers need immediate liquidity to commercialize their research. Uber provides instant access to 199 million monthly active consumers. Uber also launched an autonomous solutions suite, offering critical infrastructure and fleet management as a service to those hardware partners. Uber's $175 billion valuation is currently justified by its core logistics growth and buyback program, but this AV positioning adds optionality that remains largely unpriced in standard earnings models. Uber's performance this quarter shows the company's evolution into a dominant AI-leveraged utility, still in the early stages of its long-term intrinsic value realization.